Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, June 16th, 2023. S&P 500 currently sitting at 4424. I'm David Zarling. I'm here with David, our producer, Joachim, and Ian Kelsey McMillan. Plenty to talk about in the coming minutes here as we go through a fresh episode here. Ian, it was great to have David and Kevin on last week while you were gone in Maryland, but also great to have you back. Where should we start?
Yeah, appreciate the time off. Luckily, during this vacation, got a little bit more excitement from stocks, which continued this week. So, yeah, a big week from equities as a whole, all shapes and sizes.
Yeah, 4424 is not 4180.
I think we've definitely seen the confirmation above 4180. We've even gotten above 4200.
And when we look at the advanced decline line, something that is a measurement of breadth, using the advanced decline line of the S&P 500, we're at brand new highs in that metric. And I know you shared something on Twitter regarding Microsoft and Apple, both of them at brand new all-time highs.
Yeah, not very bearish.
Not when the two largest stocks in the world have clear skies and new highs.
Yeah.
Probably a good thing. And then when you look at things like the Russell 1000, the Russell 2000, they continue to sustain. And so we're maybe seeing some of that breadth expansion that we wanted to see out of areas like that. You know, I believe it was this episode or two episodes ago when we looked at something like small caps using IWM. We were broke important levels around 180, and we continue to see that on a relative basis. When you look at IWM versus S&P, you have the COVID lows still holding, and so time will tell, but it's really continues to be all things large cap growth and tech still leading for the most part.
Also add that we are up against an interesting level here in the Dow above 30,000, but really not out of the woods. I think you can put small caps in there again, have had a great week. Definitely not out of the woods.
What I find interesting is even that chart you're sharing there, which is the NASDAQ 100 QQQ, when you look at XLK blew through that August high and also the March high. And is that the precursor for what we'll see out of the S&P 500 and the Dow eventually? So XLK being the leader, barely paused at those levels, and the Qs are not quite at its March highs. I believe it's right there right now. And did technology lead the way and show us how we're going to handle some of these important horizontal levels? Because if we're not going to see the S&P pause at its March highs, that would be pretty tremendous information to not see that. So time will tell, but I would say that a lot of sentiment is that somehow we need a consolidation here. And I'm on board with that. If we saw some consolidation, that would be perfectly healthy for this market to move sideways and back and fill between this level and the August high. Whether that happens or not, the market tends to make fools out of people. And so we may not pause here, and you might see small caps in the S&P 500 move through their March, April highs just as fast as XLK did.
We could very much do that.
I think, too, when I look at where we've come from, so I know that Willie Delwich shared a chart regarding some of the pessimism we've seen, and we were at record levels, like records we haven't seen in pessimism since the lows in 0809, the lows in 2002, and we tend to move higher out of these when we have this type of extreme pessimism. And when you think about some of the Yardini research that we saw maybe a month or so ago, were just record shorts taking place now we have squeeze fuel, like future buyers that potentially have to cover their shorts. That's the reality of the situation. Now, would we want to see small caps continue to base out? I think it becomes even more powerful if we're above 200 or 199 on small caps.
Yeah, and then there's that neckline up there, from all of 2021.
Yeah, there's plenty to work through for sure.
It's a lot to get through. I don't expect it to, continue at the rate that it goes back to, like you said, how many people were short, how many people are in disbelief or frustrated or not quite believing, right? Because you just said there is a lot of pessimism out there. I see it in talking with friends and acquaintances. I see it on Twitter. Clearly, the media is never shy when it comes to pessimism. But is this just a relief, not a relief rally, but a rally where I would say this goes with the behavior over the last 2 or 3 weeks, where every single, 50 basis point correction gets scooped up because people are so desperate to try to now get on the right side of it and try to get position and try to get exposure. I think it makes sense with the breakout above 4180.
I think it's a fair point because I know some of the advisors that we've talked with, whether it's about ADPV or something else, how many were just a few months ago talking about how they wanted the market to return to an uptrend and how rapidly the things have changed above 4180. And if you're trying to position into this, and even the sentiment that, hey, maybe there's a pullback here, which would be welcome. I know from our side, if there was a pullback and consolidation, we could take advantage of that and use that to execute to increase exposure even beyond its levels now. However, the market is really good at not giving you what you want. And when you see things like Microsoft at all-time highs and it didn't really pause at any of these important levels, it actually gapped above its August high, barely paused at its March high, April high of 22. Are we going to see the same thing for other places that there's not going to be a lot of pausing? It's just going to be an onward move. And at the same time, I realize how giddy we sound when we talk like this, that it would make sense to have a consolidation, have the S&P pause and consolidate at current levels and bounce between here and 4180 between the rest of summer and then move higher in the fall. That would match seasonality, but definitely doesn't have to be the case. And then you see things underneath the surface like internet stocks breaking important horizontal levels and moving higher, whether it's something like FTN or PNQI being above 146. We're buying internet stocks. That's risk on behavior. And whether we see that continues, we could see those pull back into their horizontal levels. Like if we were using PNQI as an example, 141, 142 to pull back into that would be pretty normal over the summer. Because I do believe we're heading into a relatively seasonally weak period from mid-June now through July.
I thought, Dietrich showed some composite the other day. I can't remember what it was made of, but June and July were supposed to be strong.
Oh, okay.
So, right, and this goes back to data. You can always divvy anything up the way you want it. And I'm not saying Ryan's doing that at all, but I've seen both, right? I've seen seasonality charts where this is typically where we take a break, right? And it goes along with the entire sell in May and go away mantra. But I've seen some where, you throw pre-election year in there and you throw a couple other things in there and it can make it look not half bad.
A little bit of data mining, but your point is Dietrich was potentially highlighting that summer could be strong. Is that correct?
Yeah. And I think, if people feel behind in their positioning, they're going to feel need to catch up.
Well, if we've got basing out of internet stocks or even things like metaverse, right? Remember metaverse? That was a big area, not too distant past. But here you have something like the Round Hill Ball, MATV, breaking above important levels. Metaverse investing that's risk on type behavior. So we're seeing small caps hold. We're seeing tech continue to lead. Things like internet stocks and metaverse are breaking above important levels. I know we've spent a lot of time talking domestically. What about internationally? What are we seeing in that area of stocks? I mean, that can be a risk on barometer too, is how much exposure or how much demand there is for international stock.
I mean, it's okay. They're kind of repairing themselves. Europe, Argentina. Other than that, personally, there's not. I mean, I guess you can throw Japan in there. From a relative basis, not a lot working anymore overseas.
Yeah, and I think VEU, which is the all world index versus S&P, is an interesting chart from a real big term perspective. I mean, this is why we don't just blindly own international stocks in models. That's modern portfolio theory, right? You should be You should own small, you should own large, you should own value, you should own growth, you should own international, you should own some bonds. That's the model 60-40 portfolio. And here for 23 years is a downtrend that exists in something like VEU versus S&P.
Brutal.
I will say that at this point, if we were to hold this level on a relative basis, we could be creating some type of accumulation base in international stocks overall versus US stocks. But really, until we clear this rate of trend that goes back to 2010, 2011, and we get above a horizontal level that's approximately 0.0138 in the relationship, you really have to be selective in if you're going to add internationally, how you're going to do that. Not necessarily something to do broadly.
And it'll have to happen. I mean, we're going to have to get over the hump on this tech stuff. Europe's not going to outperform.
Oh, sure.
Until completed whatever we're doing right now with mega cap growth. Yeah. I don't know if it's done now. I don't know if it goes on for another year. I don't know if it goes on for another 5 years. But I just don't see investing outside the U.S. as worthwhile. I mean, clearly we've pointed out areas where you just said this is why you don't broadly buy international. There probably will come a day again where you can buy EFA and EEM and all that stuff. But have to be very selective. I don't see that changing until this cycle is done, here in the US.
That's a fair point. I mean, the chart I pulled up here is VU versus XLK, confirmed downtrend. There's opportunity costs if you're going to own broadly international, not in that relationship. It's pretty clear that if you're not owning some technology and some large in that arena, there's some opportunity costs there. What else are we seeing internationally? It could be commodities. We could talk bonds.
Yeah, I think it's all pretty, bonds, same thing. Been in a range for a month. Here, TLT below 103. Still below a downward sloping 200-day moving average. So nothing. Absolute nothingness. 8 months of this juncture below 99, maybe something happens. Above 108, something happens. Other than that, I feel like I only look at TLT maybe once a week now.
Oh yeah, because it's in this range. And
something happens, so I'll hear this screeching from the woods about it. The woods of Twitter, nothing.
No.
And so with that said, I assume TYX is going to look the exact same. Yep. Riding a 200-day moving average. Hasn't done anything since really last, Q4 2022. Maybe setting up, right? Maybe setting up for some type of move. I don't know. It's been nice not have to worry about them.
Right. They've just been moving sideways. And maybe that's part of the beauty is if you've got a rate of change on rates, that might be more powerful than directionally where they're going. You look at US too, this is the yield curve.
Yeah, hanging in there.
And so what Ian's bringing up is just the 2-year yield versus the 10-year yield. And when you look at this, we still haven't seen this pull back. And this goes back to an episode, weeks, maybe a few months ago, just talking about, is the yield curve something that you can really use in an environment where rates are consistently rising? Consistently rising can be interpreted multiple ways, but if you've got rates overall rising, is the next 40 years of a rising rate environment, is a yield curve useful? To be determined.
And I get the argument is that as soon as it uninverts, and depending on how you look at it, if you do 2s over 10s or 10s over 2s. All right, so here you've got your 2000 finally rolls over. You've got your, what is this, July 07. Here you are getting a little sketchy right before pre-COVID. So everyone's waiting for, this, right? This is, got to wait for this to somehow roll over. I mean, look at this period back here where it just meanders along.
Late 90s?
I mean, probably now I don't have all the data here. I know there's charts with more data, and maybe there's something that could debunk this, but I mean, that's pretty long consolidation. When we look at the 34 years of data we have here.
Ian's just pointing out that the yield curve was pretty flat in the mid to late 90s, one of the best bull markets there were. So you had, and that's an interesting thing to consider because the narrative definitely is interest rate sensitivity, the credit wall, lending wall, private equity. And yet, could we actually be heading into a period of stabilization in rates, which helps we actually see stocks do really, really well in that environment going forward? We could. Time will tell. But your point is valid. We continue to see bond on a long-term perspective, like TLT, AGG, move sideways. If you look at them on a relative basis, if you look at bonds versus stocks, so if you just look at AGG versus S&P, there's more demand for
sure
owning stocks, right? We continue to break to new lows in that relationship. And when that happens, that tends to be risk on appetite for stocks. And this is happening after a year-long consolidation in the relationship.
Commodities also breaking to commodities versus S&P breaking down.
You're using GCC versus S&P.
Yeah.
And so just when we were having peak gold talks and T-bills, and now you're seeing stocks do well when everybody was focused on, hey, why don't I just own T-bills? Well, the risk is that you own 5% rather than 12, 18, 25% in stocks.
Yeah.
Not all things the same. Now, do you think, Ian, we get consolidation here? If we think broadly about domestic stocks, whether you're using the NASDAQ 100 or the S&P, if you look at small caps like IWM, that's still technically consolidating. That's a range that goes still back to last year. But this move we've seen out of large cap and growth, we going to get a pullback here?
I don't know. I'm split on, certainly visually, it looks like a classic too far, too fast. Certainly not long-term bearish, but if you're looking at the next couple weeks or maybe a month or two, it's a lot.
But I know you shared something internally about distance away from a 200-day, right? Or away from a 50-day moving average, that we're at a pretty large extreme.
We're about 5%, well, now over 5% from the 50-day, which historically has been a pretty good indicator of at least some type of short-term pullback.
That makes sense. I mean, you're just saying from an average standpoint of the past 50 days, we're up against levels that have been extended in the past. I believe when we looked at the late 90s, not to harp on the late 90s, there was some extension away from the 50-day. Sometimes it's one of those things where the moving average catches up to price, right? Because 50 days ago is April 6th, and will you start to see an acceleration as that range that happened in April starts to drop off the data set? You'll start to see the 50-day accelerate to the upside. That's definitely possible.
Definitely possible. Another thing that I think has been pretty bullish is, we've had a few gap downs. It's not like this has all been, we're going to gap and go. There's been a lot of gap downs, not just in stock or not just in indices, but in individual stocks that, again, that behavior where people are, I think, a little behind the ball. And it goes back to things you've pointed out of how short were people going, Not just the T-bills. I think a lot of people got pushed into gold, which you brought up, and this is gold going to 3,000. Maybe it does. I'm not saying gold has to go down, but if it underperforms stocks,
Well, it's still within
it's
its
an
range.
opportunity cost.
Right. It's still within its range that goes back to 2020, which happens to be a range that wraps around the highs from 2011. And so gold doesn't have to be something that we get super aggressive with in this environment. We can wait for this consolidation to play out, and that's perfectly normal. If you really have to wait to see, I'm using GLD, but futures look like this too, but using GLD above 190, that is a pretty decent level that you could manage risk and reward with. But your point about something like gold versus stocks, I know you shared a chart where that's breaking a short-term rate of trend and broadly in a downtrend since 2011. So not really, it's an opportunity cost there. So there's opportunity costs in bonds, there's opportunity costs in commodities. And so now it's really about where are we going to be in equities. Yes, there's still crypto. We could talk about crypto, but you could look at something like Bitcoin versus S&P, and that's still below in that relationship, below important levels, and from a weekly and monthly time frame making lower highs, so in a downtrend. So really right now, stocks are the game in town. And to your point, Ian, that you were talking about, more domestically than internationally. There's pockets internationally, and you have to be selective. And we're seeing, the good news though is we're seeing that rotation, that broadening out of the market using things like small caps. And it doesn't mean they're outperforming, but they're participating, which is good.
I've certainly seen that. You've seen the defensive sectors really underperform. Healthcare's taking it on the chin.
Yeah, what is that about?
Certainly, I would put biotech in there, which then I go, biotech underperforming is not great for the Russell. But yes, everything from medical devices to...
what chart sketches me out from the healthcare thing that you're talking about is just United Healthcare.
Yeah, I saw. Then United Healthcare kind of had a bad week.
Yeah, and it's right against this 460 level, which is a horizontal level that goes back to November of 21. Right, it's the largest component of the Dow. So this goes back to the chart you shared on the Dow, where we're right at important horizontal levels. United Healthcare needs a hold here from a Dow Jones perspective, healthcare perspective, and we could argue large cap value from a value perspective. But you're right. If you look at medical devices, that's one area has potential bottoming, but then healthcare services or healthcare providers, those look a little less appealing. And Moderna too. Moderna's right up against the 122 horizontal level. Pfizer's below important levels. So not all is well in the healthcare part of. There's multiple ways to interpret that. Is that risk on because healthcare is safety, or like a risk off play? I don't know, but it's worth paying attention to some of these areas in healthcare that don't look all that great. What else, Ian? What else from a risk on, risk off perspective, or even, David, I know you're on this episode as well, helping us manage our production. I think you mentioned you wanted to touch base on a rotational regression graph, RRG.
Yeah, there was. So shout out to stock charts for being able to do this, but we've seen recently a lot of notion of we need to see rotation out of tech. And then, of course, the parade was cheering last year that we need rotation into tech. So it's just a nonstop cycle of people wanting rotation because they end up late to the party and then they want something else to look at. So with the RRG chart, which I'll share on Twitter this weekend, recapping the podcast, you can see that we're starting to see some rotation out of some of those risk on. We've said we've seen a lot of rotation and breadth go into technology, communications, consumer discretionary. And now we're starting to see a little bit of change with, you have materials, utilities, healthcare, all starting to make its way around the chart. into the improving sector or improving quadrant there, and then heading into the leading. So, of course, none of these metrics mean they have to continue in the direction that they're heading now. But in terms of momentum and some of the analytics that RRG charts look at, you're definitely starting to see some rotation into those more defensive names as tech starts to get a little overextended.
So you're saying the potential there for a little bit of rotation into safety and some consolidation broadly in some of the tech areas could be showing its head through looking at something like this, like an RRG.
Yep, absolutely. We could use it. It never hurts. Everyone wants everything to go up all the time, but you need supply and demand to be able to settle down and find some more buyers. So never hurts to see some rotation into some defensive names every once in a while.
Yeah, for sure. Absolutely. Totally agree with that. At this point, I think I want to make sure I highlight the supporter and sponsor of this podcast, which is the Adaptive Select ETF, which is listed on the NYSE under ticker ADPV. Adaptive Select helps investors access two of the most prevalent factors in markets, momentum and relative strength. Through proprietary identification methods, the Adaptive Select ETF attempts to own the strongest 25 large cap stocks when the market is in an uptrend. And since not all markets environments are the same, Adaptive Select seeks to prevent extended declines by moving to short-term treasury bills and cash during long-term market downtrends. Investors can find out more, including how to invest in ADPV, by visiting adpvetf.com or calling 1-833-880-5200. Adaptive Select is distributed by Quasar Distributors. As always, investing involves risk, including possible loss of principal. So now that we've highlighted our sponsor, what else do you guys want to touch base on as we head into the final portion of our podcast? Anything you guys would like to highlight before we wrap it up?
No, I'll say big week for a lot of the agricultural commodities.
Okay.
So interesting rally they've been on, especially as the inflation talk has certainly died down.
Okay. And we lost the ETNs representing a lot of commodities. Barclays closed a lot of those down. But now we're seeing, are you talking like corn and wheat and things like that?
Soybeans, I think, has been on a pretty good run.
Okay.
Cattle.
And this is all happening with the trade weighted dollar right against this 100 level.
Cattle.
Well, let me ask you this, Ian, and David too.
Soybeans, sugar.
When you look at the trade weighted dollar, if we were to break this 100 level, this ties into all sorts of things, from whether it's Latin American stocks to the commodities that Ian just highlighted to inflation that Ian was just talking about. If we're breaking this 101, 100 level, that's going to be an interesting dynamic to watch, just from, does inflation rear its head again? Because you're seeing commodities do so well, stocks as a whole, you would think, with a dollar below 101 or the 100 level, that'd be a pretty big tailwind for stocks as a whole.
It would. It absolutely would.
So something to monitor, something to watch.
And maybe that's what gets foreign, right? We've seen a strong dollar recently. Not great for foreign. China's certainly been weak. Yeah, maybe that's what finally gets it all in gear.
Gets international stocks participating more than just on an absolute basis, but maybe relative outperformance. Anything else from you, Ian or David? Do you have anything?
I would just say it was a pretty good week in the markets. We only had one sector out of the 12 that was negative, being energy down 0.5%. Technology led again 5%, followed by consumer discretionary 3.6% and communications at 3.2%. Seeing some industrial names pop up in breadth too, so that could be something to monitor.
Yeah, someone said yesterday like 70 of the 72 industrial names in the S&P were up. And I think they did break, XLI broke to new highs.
And then if you just listen to what David and Ian are saying, right, you've got energy weak, but you've got these other cyclical areas, economically sensitive areas moving higher, along with risk-on areas moving higher. So the evidence continues to suggest onward strength in stocks. Time will tell. We don't know the future, but whether consolidation or not, the evidence continues to suggest that it's higher from here 6 to 12 months out. Well, I appreciate you guys being on and doing this. I know we're trying to do some new things, including potentially putting the podcast in video format. So, David, I appreciate your work on that. Ian, as always, it's great to have you on here. It's great to have you back. And we always appreciate everyone listening. And we hope that you guys, whatever platform you're on, your favorite one, you give us a high ranking, share it with your friends. That helps us get the word out and repays us for the time that we try to take to share with you guys. With that, Ian, happy Father's Day.
Yes,
David, your time will come whenever the Lord wants it to be there. But happy Father's Day to all the great dads out there. Thanks for making us tougher. We appreciate it.
Have a great weekend, everyone.
Have a good one.